Hey there, let's talk about ETFs. We were asked by Fiddle5203 if we would talk about ETFs, and in particular JEPI. This one's for you, man.
You asked for it. We did it. We got you ETFs.
What is an ETF? Do you guys know? Anybody know what ETF stands for?
ETFs in general are a lot like mutual funds. So if you're looking at an ETF, you're going to look at a mutual fund, they're pretty similar. Why?
Because it's an exchange traded fund.
Very good.
ETF.
Very good. We looked that one up.
We did.
Now JEPI's fun to say. Is it JEPI or is it JEPI? Because like if you're a mutual fund guy, let's say you got a 401k and you're walking down the street and you want to know, so like, oh, what are you investing in? And you can say JEPI. You're like, well, what is that? And you could just, it just sounds
JEPI.
fun. Just like
let us know in the comments whether it's JEPI or GP or just JEPI.
Yeah, and if you go back to previous videos, you'll notice that I butchered some of the names like Elon Musk and Jeff Bezos, so I'm sorry guys. But the JEPI is an ETF that's very similar to a mutual fund. Now, personally, in our portfolio, we don't typically buy ETFs. There's a few reasons for that. If you have a job that pays a 401k and you max that out, that income that you max out with is about $2,000 a month in the United States. That is pre-tax. Now, if you have enough income where you're putting into your 401k and you're maxing that bad boy out, you're probably in the 25% tax bracket at a minimum. So if you're in that tax bracket and you buy it in a 401k, you're not paying taxes. But if you buy the ETF, then you're going to have to overcome the difference of tax.
With like an IRA or something like that.
Yeah, that's a pretty big difference. So immediately right out of the gate, and it's not just JEPI or JEPI, it's all, any after-tax investments that you make. So they automatically have to come up with 25% more.
Right.
Just out of the gate. And the index funds, you look at this particular fund and you look at all the index funds and mutual funds, they typically track with the S&P or the index funds in general. So, that's usually between 10 and 14% per year. Sometimes it's more, sometimes it's less. This year, not so good. It's a bear market year. As far as the stock itself goes or the JPI goes, I don't have a problem with mutual funds. If you're a beginner, they're not a bad way to go.
Right. You could put your money into it. It's fairly safe. It's going to go up over time. So if you hold it 20, 30 years over the life and you keep putting into it, you're going to do okay. You're probably going to get a tidy profit from that.
Yeah, and that's shown in basically many, many examples over time. We don't have to go through those again. We did a few videos prior that talked about the snowball effect and what happens with dividends. And you can even look at our own portfolio. Once again, it's once a month, so you can check our prior videos and see what we purchased and why we purchased that. And that gets into a little bit about why we're doing the analysis on the ETF here. So outside of the 401k and the taxes, there's some other things that I don't like about this. This is me personally. When you buy a stock, you have a legal ownership claim in that company. You're buying a piece of the business. When you buy an ETF, you're not buying the company directly. You're buying it through the ETF.
Right.
So your valuation and your ownership stake is to the ETF and not the business.
And the management team who manages the ETF.
Right. So the problem with that is if they go bankrupt or if the company does extremely well, that just gets muddied into the ETF. And that kind of creates a problem for those super great gains that you can get over time. The other thing that I have against ETFs, this is again me personally, is that if you are a $10 million company and you're an ETF, in this case, this one has $16 billion of valuation. If you're buying as an ETF, you want to invest in a business, you have to find very specific types of companies. These large mutual funds and S&P 500 and index funds, the reason why they track with the index itself is because this is a lot of money, folks. This is a lot that people have to put into a company to invest in. And that company, in turn, just like we talked about with Zim, they have to do something with that money to get you a return on that investment. That limits you quite a bit in what stocks that you can pick. The other thing that, I'm an investor that's pretty active, you get no say in the ETF. But if you're a beginner, you're paying for people to do that. There's a whole management team there. There's an executive there. There's people that will find these stocks and pick them just like what we do. Problem that we have with it is that you're paying a fee in the ETF itself for them to do it. And I think this one is 0.35% on that. I think that was the fee that one provides. We did a podcast. We kind of went through a bunch of different ones as far as mutual funds. And one of them stuck out was Vanguard Fund. That was an income fund. And we looked at all the ETFs across the board on what their dividends they paid. And it hovered around 3%.
Yeah, 3.5.
Yep. So why is this one paying 10%? Like, yeah, but Tom, if it tracks with the S&P, I'm still getting 10% dividend, right?
Right. But I think that really comes because it doesn't have a lot of history. It was incepted in 2020, and it seems like they're giving 10%, trying to get people to invest, to grow their fund, to compete with other funds.
That's the nearest that we can tell. You see this sometimes, like there's a Vanguard fund that pays dividends, and this gets to a whole different topic around the principal appreciation versus dividends. But as far as the ETF is concerned, when you see a high dividend like that, that's a red flag. It's either, in this case, the nearest we can tell is they're trying to bring it in to compete with Vanguard. This is an introductory rate. We don't think it's going to last.
Or Schwab.
Yeah, it could be any one of the mutual funds out there they're trying to compete with. So they're trying to bring business in, and it's working.
Right.
I mean, they got 16 billion so far, so
Isn't bad.
It's not bad. If you're going in to compare them with the Vanguard fund, Vanguard pays a lower dividend. It's only like 3%, but they gained 17.5%. And then this one is 14%, which is exactly what the index fund did, but they pay a much higher dividend. So overall, if you had more history, you could see really what they do, because one year it's going to do great, one next year might not do so good. We talked about that too with our own portfolio. We're beating the market by quite a bit this year. Well, it's a bear market. Dividend and safe investments tend to do really well in bear markets, and in bull markets they don't tend to perform as good because people like to pour into riskier assets, I guess.
I think we can make a pretty bold prediction into the fact that over the next 5 years you're going to see a dividend, as people invest into it, go down.
Yep. It'll probably bring down into correlation with what all the other mutual funds and ETFs out there do. You really want to look at who's managing the ETF, who's behind the decisions they make, what kind of companies are they buying. And this is another red flag that came up, was their turnover on the stocks they're purchasing is really high. It's like 195%. And then when we looked at the Vanguard one and all the other ones, it was only like 13, maybe 20.
So for those who don't know what turnover rate on ETF is.
Oh, that's just basically them buying and selling the stocks. How many times do they make a transaction per month? And usually the transactions correlate to fees. Transaction fees. They gotta buy the stock.
People,
you pay people to do that. So you want to see low turnover in that regard. And the reason why we in our podcast we wanted to see the difference between one that was more established.
Right.
And that's why we did the Vanguard one. There could have been other ones we looked at. There was a few out there that were on the list. We just decided, nah, they're all pretty similar.
And it could be that high based on the fact that they are new and they're trying to figure out what their stock base is going to be for that ETF. And then once they find that, it'll even out.
Yep, and some of the companies look great. Most of them looked okay. Some of them were, I wouldn't buy that one right now, but it's what they're picking right now. If you compare the ETFs to each other, you're going to notice a trend. Kind of another problem is they all had like the same, like ExxonMobil and Chevron. They had the competitors.
Right.
So they all had
Verizon and AT&T and
they all had the same companies too. So like you had ExxonMobil, Chevron, and JP Morgan Chase, which obviously JP Morgan Chase would buy their own.
Right.
It makes sense.
Makes sense.
You had a lot of the same companies. The Vanguard fund had a lot of the same companies. And so you're really looking at it. Gets back to my point of, when you get into the mutual fund realm and the ETF realm, you're basically doing an index fund. And if you track all these mutual funds compared to the S&P 500 going back, 100 years, you can go back a long time, and it's very rare and very seldom that they will do any better than it would do with a S&P fund. So like an index fund. They track pretty closely. Are you going to get the 10% dividend? You probably get a dividend, but if we were betting people, it's probably going to go back down to match what the other ETFs and mutual funds out there provide, because they're the same companies.
Right. I mean, you're going to get the 10% because they're offering 10% if you buy it now. If you want to get in and ride that 10% and get that in the first year or two that they offer it, then hey, bonus. But don't expect that over the long term. And if you do buy it, I would hold it over the long time, because this is not a get in and buy low, sell high type thing.
Keep an eye on the turnover. If you buy it and you want to hold it long term, that turnover is going to be a pretty good indication about how stable the management is with their investment choices.
Yeah.
The lower the turnover, typically the larger the cap stock you're going to see. You're going to see a lot of the AT&Ts and Verizons and DuPonts and Johnson & Johnsons of the world show up in those stocks. I think they both had General Dynamics in there.
Yeah,
so.
you all the dividend aristocrats and dividend kings in there.
Yeah, and that's because of the amount of assets they have and what they have to purchase with that. If you're going to buy an ETF, is this one a bad one? No, I mean it's not a bad ETF, but don't count on that dividend to stick around forever. And again, if you want to beat the market and you want to make the most value for your investment, do a 401k that's pre-tax first. Get into those. The mutual funds and ETFs are similar. There are some differences. The 401k itself is pre-tax. So
Especially if you have a company that matches. So if they match 100% of what you put in up to 4%, you put in 4% because you're doubling your money at that point. Your company is going to give you extra money. If you don't put that in, then you'll just leave that on the table.
And there's another point to this too, is when you invest pre-tax in the 401k, you actually reduce your taxable income that you pay in taxes. So at the end of the year, it's a tax benefit too. So you're not only getting, if you get a company match. Now, we looked at this, and I guess 50% of the companies out there only offer a 401k, and of that, only 50% of that actually pay a match. I think that's sad. Come on, people. I mean, these are people that make your companies work. Give your people a 401k, help them retire. They're helping you. I'll get off my soapbox. but that's the 401k, you get the pre-tax investment, and that means that any ETF or mutual fund that you're going to have to pay has to somehow come up with whatever your tax bracket is and beat that before it even hits zero. Then you get the tax deduction on your taxable income. And on top of that, the company does a 401k match, then you get that too, and that will cover the fees. Usually the fees usually go above 3%. Usually they're 0.5%, 1% at the most. The mutual fund fees are a little bit lower than ETFs typically. If you get to the point where you're a hands-off investor and you have maxed out your 401k, you maxed out your HSA. Now you can do these things even if your employer does not provide one. There's your financial planner, if you've got one. We're not your financial planner. They can help you get that set up. That's one way to help that if your employer doesn't necessarily do that. Those things happen. You've maxed that out. You max your 401k, you max out your HSA, then you're looking at buying stocks and you want a hands-off approach. ETFs and mutual funds, even if it was a 401k that was you wanted to add on top of the max deduction for taxes, that's not a bad way to go. Dividend dudes, we don't do that. I like to have a say in what we pick.
And we take the time to investigate the companies that we want to invest into. If you're not going to do that, ETFs are a great way because you're paying somebody else, a whole team, to do that for you, and you're hoping that they do a good job.
Yeah, and I have, personally, I don't like the idea of not having an ownership claim in the company that I'm investing in. Who knows what this ETF will become. Maybe it'll be good, maybe it'll be bad. There's some legal ramifications about if a mutual fund goes kaput. Like I said, ETFs, our suggestion, and what do you think? They're not too bad for beginners?
So bottom line, beginner, ETFs aren't bad. Go ahead and get into it. There's several out there. JEPI is one of them. They have a 10% dividend right now. If you get in now and you're going to hold it for 30 years, you're going to get a jump start on with that 10% dividend for the next year or two, however long they do it. If you're a little bit more established and you follow us and you want to do the individual stocks, you could get a better rate of return that way. And I would suggest it. Otherwise, make sure you're doing your 401k first.
Yep, do that. And if ETF seems like too much, there's too many fees and you're worried about the turnover, quite frankly, most of them are going to track with the index funds. Just buy an index fund at that point.
Just go to the S&P 500 index and you'll do okay too.
Yeah, you'll do fine. And now short-term stocks can do this, and you can see it in almost every single stock. There's a wave. S&P does that too, but over the long period of time, it tends to do pretty well.
Hopefully we've explained well enough JEPI and our viewpoints on it. We could be wrong, but we don't think we are. If you have any comments about that, go ahead and put them down there. Put an emoji down there if you don't have any other comments engagement.
We're not always wrong, but when we are, the trolls eat us alive.
Yes, they do. And as always,
happy investing.